Gerard Cassidy, Managing Director, RBC Capital Markets, co-head of Global Financials Research, joins us now. Gerard, you've done some really nice historical research on this, looking at, when you have a rate cutting environment coupled with no recession, here is how banks perform. How are you looking at this, especially given just the overall evolution of the banking system over the last 25 years, which is really the only historical comparison that we can make? You've got larger banks, you've got more competition with non-banks. Do all the same rules still apply?
Thank you, Leslie. I would say that many of the rules still apply. Most importantly is the fact that banks obviously have deposits. That's what sets them apart from anybody else. So what we're likely to see as the Fed starts to lower interest rates, their funding costs are actually going to start to decline. But when you think about their assets, many of the banks have put on billions of dollars of loans and bonds from 2020 and 2021 at yields that are extremely low. Those assets are going to mature over the next 2 to 3 years in a higher rate environment, even though rates are coming down. But their funding costs are going to fall faster, so margins should open up. So that hasn't changed from the comparison period we wrote about, which you just referenced, was 1995. That's the only time period that the Fed was cutting rates under Greenspan, and we didn't have a recession. Banks were up 55% that year. Credit is critical for banks, and if we don't have a recession and they're cutting rates, stocks should do pretty well.
What do you think is going to happen with loan demand, especially now that we have 50 basis points versus 25? We know kind of the magnitude of these cuts. Is that going to really accelerate loan demand? Is it enough, or do we need to wait to see kind of more deeper cuts, a greater magnitude of easing?
I think we need a greater amount of cuts for magnitude, and the magnitude of easing has to come in. When I came into your studios today, I was talking to your security guard, and he was asking me about what I was going to talk about, and I talked about rate cuts. He said they have to fall a lot more before I start borrowing. So there's a real live example of a regular person. Yes, we need to see rates come down at least 100 basis points before really people start, I think, borrowers really step up. That may start happening in the first half of next year, because historically, our loan growth in this country mirrors nominal GDP growth. So if we have nominal GDP growth next year of 4 or 5%, loan growth could come up from about 1 to 2% today, possibly 3 to 4%. With a wider margin, revenue growth for the banks could be pretty impressive.
Is there a sense that the recent commentary about trading activity and fees could have been better? And if so, you think it's just a pause here? You think it gets better in light of what happened this week?
Yeah, good point, Carl. And the commentary on trading particularly has been not as positive as people would have liked. Part of the reason is the comparison to last year is a tough comparison. So I do think that in a falling rate environment, if we can get the investment banking business, specifically ECM, specifically IPOs, to come back, that will bring along trading activity as well. Trading activity is linked to volatility, so that's the other area that you do need to really lift trading. But it was really a comp comparison that made it difficult for trading.
Finally, back to Bank of America, which we were just talking about. I mean, they would seem to be a beneficiary of those rates coming down, given that very large bond portfolio that concerned so many investors during the mini banking crisis of March of 23. That said, Warren Buffett keeps selling stock. I'm just curious as to your thoughts about the performance and or the future of that company.
No, you said it well, David. They did get penalized during that small banking issue we had in March of last year and all of last year because of their bond portfolio. But it is odd. Obviously, I don't have a call into Warren Buffett, and so I don't know what his thinking is. And as Leslie pointed out, he's made an enormous amount of profit in that investment. But if we are correct in that we don't go into a recession and the Fed continues to gradually lower front-end rates, you get a steeper yield curve, loan growth picks up a bit. That's setting Bank of America up very well. They've got they have the best deposit franchise, them and JP Morgan in the country, and that will really benefit them, in our opinion.